Welcome to Alpha Insights. I'm Lucy. Today we're digging into a tricky set of headlines in the cannabis sector. And joining me is Kate, a fixed income specialist who follows regulatory and market signals closely. Kate, great to have you. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks for having me, Lucy. Glad to be here.
So, let's start with Illinois. This one surprised some people. The state sold a record 58 million items last year, but revenue actually fell to $1.5 billion, down 13%. Kate, what's driving that mismatch between higher volume and lower revenue?
Honestly, I was a bit surprised by this one. The short version is price pressure. You can sell more units, but if the average selling price drops enough, total revenue can fall. That usually means margin compression for retailers and producers. They're making less per item sold. I mean, when you look at the data, it points to heavy discounting, increased competition, and a shift toward lower-priced products. Right. If costs don't come down at the same pace, profitability suffers. For investors, the practical questions are, do you own high-cost producers that need higher prices to make money? Or do you own brands or operators that can preserve margin through premium products or scale? Promotional activity can boost unit sales, but it's a race to the bottom unless companies find higher margin channels.
So in other words, volume alone isn't a green light.
Exactly. Volume growth looks good on the surface, but you need to dig into average selling price, product mix, and cost structure.
Moving to regulation. Nebraska approved a medical program last year, but it wasn't included in recent federal protections that limit Department of Justice interference. What does that omission mean for operators and investors?
That's a big deal in the short term. Exclusion from federal protections doesn't make activity immediately illegal at the state level, but it raises the risk of federal enforcement and creates uncertainty for banking and financing. Companies planning to enter Nebraska or funds backing expansion need contingency plans, legal counsel, conservative capital deployment, and awareness that policy could change suddenly. Regulatory risk often translates into valuation risk.
Interesting.
Yeah, that's a good point. For investors, the takeaway is to demand clarity on regulatory exposure before adding positions tied to new programs. Watch for congressional action or DOJ guidance. Either could lift or deepen the uncertainty.
Let's touch on the demand story. A recent peer-reviewed study using CDC data showed long-term declines in teen cannabis use, with about 30.1% of high school students reporting ever trying cannabis in 2023. How should investors read that?
That's a helpful data point for the policy narrative. Long-term declines in teen use make it easier to argue for regulated markets. But it doesn't immediately fix the commercial problem of falling prices. Social acceptance and policy tailwinds are positive, yet companies still need clear margin recovery plans.
And what about the culture side? Lifestyle plays like cannabis events on golf courses and other experiential rollouts.
Those are interesting growth levers. Brand extensions, events, and non-combustible products can command higher margins if done well. But scale matters. These initiatives typically take multiple quarters to become material. Think of them as long-term margin enhancers, rather than immediate fixes. To add to that, investors should watch a few catalysts closely. Upcoming state sales reports, any congressional or DOJ movement on federal protections, and company earnings where management discusses pricing trends and cost cuts. And if you follow names like Tilray, Curaleaf, Green Thumb, Trulieve, or the major cannabis ETFs, pay attention to guidance on margin and product mix.
Quick reactions. Any red flags you'd call out for portfolio managers right now?
Yes. 1. Exposure to high-cost producers without a clear path to margin recovery. 2. Bets on newly legalized states without contingency plans for regulatory risk. 3. Assuming lifestyle plays will immediately offset commodity weakness.
So what should a listener do if they own names in this space?
Practical steps. Reassess cost structures and break-even price points for holdings. Favor operators with strong brands, diversified channels, and proven cost discipline. and trim or avoid investments that rely solely on rising unit volumes without margin improvement. Also, keep an eye on legal developments in markets like Nebraska. A regulatory surprise can move prices fast.
Great. Before we close, could you give 2 or 3 quick takeaways for listeners?
Sure. 1. Rising unit sales don't guarantee revenue growth. Watch average selling prices and margins. 2. Regulatory clarity matters. Recent gaps leave some new markets exposed to federal risk. 3. Cultural and lifestyle expansions are promising, but they're a multi-quarter play, not a short-term offset to pricing pressure.
Thanks, Kate. That was really clear. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for listening to Alpha Insights.